All right, Ed Yardeni is president at Yardeni Research. He's joining us right now to take some questions. Ed, great to have you with us back on the program. Thanks very much. You know, the last time we spoke, which was on the 28th of last month, you said that you expect the Fed to hike by 75 and then stop. That's it. Do you stick with that? Because since then we've had a couple of data points, right? The most prominent so far has been the jobs number. Go on.
Well, I think that when we spoke, there was some possibility that it would be 50 basis points in the September meeting rather than 75. I think now everybody's kind of back to 75 basis points. When I say stop, I really mean pause. I think we're all going to look around to see the extent to which raising the Fed funds rate by 75 basis points has an impact. So I think they are going to pause for the rest of the year. And focus on how this is all impacting the economy and the inflation rate. Let's keep in mind that the Fed is really just starting its quantitative tightening program of reducing its balance sheet, and that's equivalent to at least the 50 basis point hike in the Fed funds rate. And the dollar's been very strong, which is also equivalent to about 50 basis points. So I don't think the Fed's going to have to raise interest rates as high as some people think, simply because I think there's already tight monetary conditions.
Okay. Ed, good morning. So what does that mean for the equity markets? Because, we've seen a decent rally. In India, for example, from the lows, we've rallied about 15%.
Yeah, I think we did make a low on June 16th for the bear market. I think we're maybe back in a bull market, but I think it's going to really be a sideways market for a while. So it's not going to favor the bulls or the bears. The fact of the matter is on June 16th, the forward PE valuation multiple was down to 15.3. Now we're back up at 17.4. So it's been quite a bounce in the PE valuation multiple. I don't think it's likely to go much higher. And meanwhile, investors have been worrying about analysts cutting their earnings expectations, and that's exactly what analysts are doing now. They are cutting back their earnings.
Well, Ed, that's a valid point you're making. The Indian market's trading at a bit of a premium. The last time we chatted, you told us the preference would be to India in comparison to China. Now, valuation-wise, the gap is even more because we rallied even more from there. Is China looking tempting, or there are too many headwinds out there? You'd rather stay out of there?
I think there's way too many headwinds, and a lot of them are political, and political headwinds sometimes can be ignored. But I think in the current situation, they need to be respected. I think investors, global investors, international investors, would be better off looking elsewhere other than China. The government is much too active in managing how businesses are run. And the geopolitical tensions over Taiwan are getting increasingly belligerent. So again, I think China should be avoided.
Ed, from the emerging market basket, India stands out?
Well, I think in a global portfolio, I would continue to say that I would overweight the United States. That doesn't mean that I would invest only in the United States. And if I'm ruling out investing in China, and it's getting hard to invest in Eastern European emerging markets, India certainly gets a higher market weight on a global portfolio.
Ed, just to take that point on China forward, we had Paul Schult with us earlier, who was saying that if you go to big money managers in the US and ask for money to put into China, I mean, you risk being thrown out of offices. Is it that bad? Or was he just exaggerating? I mean, just trying to get a sense of how adversarial is this now? Yeah.
All I can really say is that it's pretty clear that it's not an environment that's friendly to investors. It's a hostile environment to investors, even within China. We've seen the Chinese government change rules of how businesses can operate. And so I think investors prefer some good governance. They prefer a situation where companies' managements can make appropriate decisions that aren't too influenced by political pressures. And I think as a result of that, for now, I would stay clear of China.
Okay, stay clear of China. Ed, what's the likely trajectory for the dollar according to you? Because that will have direct bearing on markets and flows.
Well, you know this expression, Tina, there is no alternative. That was over the past few years when people said the only place you can put your money was in equities. And of course, the first 6 months of this year, that was not the case. But I would come up with another term, and that's TNEC. There is no alternative country. I think when you look at the geopolitical mess around the world, global investors looking for liquidity, looking for governance, looking for relative political stability, I think the U.S. stands out. And this is not really so much a forecast as an observation because the dollar has already been very strong. So global investors have been coming to the U.S. And the data that the Treasury provides on net capital inflow shows that over the past 12 months through May, $1.5 trillion net came into the United States, and about half of that came into our fixed income markets. So global investors are voting with their money, and they're clearly voting to put money in the U.S., and we're seeing that in the strong dollar. And so I wouldn't go contrary to that trend at this point. I think the dollar may remain strong, could get stronger, but I think it's going to remain strong.
Ed, over the weekend, or was it Friday, Ray Dalio put out a blog piece talking about how tensions between China and China and U.S., right, with regards to Taiwan, are the highest ever, Again, I mean, there's no way to kind of call these things, but your thoughts on how this may impact risk appetite overall in the region?
Well, I think everybody's in the back of their mind worrying about a worst case situation where there really is a military conflict and the impact that it would have on global trade, especially since Taiwan is so important in the global semiconductor trade. And then, China's got a lot of business, does a lot of exporting to the United States, does a lot of exporting to Europe. I don't think the Chinese economy can really hold up if suddenly there's a military confrontation that really impacts global trade. So I'm hoping that there's not a military situation that disrupts global trade, because as it is, the war in Ukraine is disrupting things badly enough. Again, the world clearly has become a messier environment, but I think on balance, there's still good opportunities in the U.S., in India. Europe, I'm not as interested in right now because of the potential of an energy crisis going into the winter. If for some reason the Europeans are able to avoid that kind of crisis, then I'd be a very aggressive buyer in Europe because stocks are cheap there.
Okay, so just one last question. In terms of greed and fear, we had peak greed, right? Peak fear, rather, in June.
Peak fear, yes.
Are we reaching peak greed or not quite? I mean, are we still some distance away?
Not quite. Not quite, though. The meme stocks are back, so maybe that's an indication that risk on is coming back too aggressively here. But let's see what the CPI number does tomorrow, how the markets respond to it. Again, I did think early on that 3,666 on the S&P 500 on June 16th was the low. But now that we've had this 13% rally, I think we may very well move sideways for a while.
Good speaking to you, Ed. Thanks so much for stopping by and giving us your view on the global markets and different asset classes as well. Looking forward to chatting up with you in the coming weeks.